Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss my dividend growth portfolio and a major dividend cut that's coming from one of my largest income producing positions. And if you're new to the channel, I have a dividend stock portfolio worth just under $100,000 built up of 25 blue chip dividend paying companies who pay out a growing dividend every single year. And through my young investing journey, this is the first time I'm going to undergo a dividend cut from one of my positions. And that company will be AT&T, the massive dividend company with a yield always right around 7%, is expected to cut their dividend after the $43 billion deal to sell out of their WarnerMedia position, and that company is going to merge with Discovery later on next year. So this is a huge announcement for AT&T. They're selling out of their WarnerMedia position and their holding that they just purchased around 3 years ago. So in this video, I'm going to discuss this merger and I'm going to share with you my plans and what I'm going to do with my AT&T position. And it is one of the larger holdings in my portfolio. And right away, I'll be completely honest, I owned AT&T for the passive dividend income. I wasn't expecting any massive share price appreciation. Over the long term, I was expecting it to slowly go up, but nothing major. And we can see at this current point in time, I own 164 shares and I'm up 10.6% on my position. And of course, I have been collecting that massive 7% dividend every single quarter. So my total return from AT&T over the past 2 years that I've held this position probably sits between 15 and 17%. So not a bad return from one boring blue chip company that was there just for the passive income. And now we're going to discuss the merger in a little bit more detail before I share with you exactly what I plan to do with my AT&T position. So if we jump back over to the CNBC article, AT&T has announced that they're selling out of their WarnerMedia position for a deal worth $43 billion so it can merge with Discovery and create its very own company. And if we take a look at some details, this is going to pave the way to create a very large media company, second to only Disney, to help rival the streaming giants in Netflix and of course Disney itself. And under the agreement, AT&T will unwind its $85 billion acquisition of Time Warner, which closed just under 3 years ago. They are going to form a new media company with Discovery, and the deal would create a business separate from AT&T that could be valued at $150 billion, including debt. So this is going to be a major media company, and to put it in perspective, Netflix, the number one streaming name in the world with over 200 million monthly paying subscribers, currently has a market cap at $218 billion. So this new company could really be rivaling Netflix in their size once they are created. And of course, AT&T said it would receive $43 billion in a combination of cash, debt, and WarnerMedia's retention of certain debt. So AT&T shareholders will receive 71% of the new company, while Discovery shareholders would own 29%. So of course, the value delivered by AT&T in this deal does outweigh Discovery, and that's why their shareholders will retain a majority ownership of the company. But there's one very important aspect that I want to know, and the reason why I've made my decision on what I'm going to do with AT&T stock. If you read here, it says AT&T shareholders will own 71%, not AT&T. So AT&T as a company, as a corporation, is its own equity that acts as a person. AT&T itself is not a shareholders. I currently am a shareholder of AT&T. So once this deal goes through and the merger takes place and the new company is formed, proportionately, I should receive some shares of the new company, and all the AT&T shareholders in total will be distributed 71% of the new company's outstanding shares. So overall, I'm trying to make it very clear and hope I can help you understand that AT&T itself, the telecom company that trades under ticker T, will not own 71% of this newly created merger. The shareholders will, not the actual company, which is why I made my decision to sell out of my AT&T position. I currently own the company as I'm recording this video, but as the market opens, I will be selling out of this position completely and entirely. I will get rid of my entire 164 shares, lock in my gains and use that cash and deploy it into other companies. And I'm going to share with you the reasons why. So currently AT&T right now trades for about $31 per share. And over the longer term, this company is actually down close to 20% over the past 5 years. So not a lot of capital appreciation whatsoever, and over that time frame, you're actually losing value of your holdings. But of course, what made AT&T very attractive to investors was that high dividend, right around 7%. And this was a dividend aristocrat before their upcoming dividend cut. So of course, when I hold companies, if you're a subscriber to the channel, you know I have a very long-term perspective, and I have no intention of selling out of any of my positions anytime soon. And for all the companies that I own, I have an understanding of their business model, and I do believe over the longer term, and I'm talking 5, 10, 15 years, they will all continue to grow, generate positive cash flow, and pay out a growing dividend. And the only time I decide to sell a company is when a few things happen. A dividend cut. As simply as possible, if a company is forced to cut their dividend, that means something has changed within the business, or they're not financially stable enough to maintain their payment. And the second one is pretty much the main reason why I ever decide to sell a company, and that is if the underlying business has changed in a fundamental way, and that clearly has happened with AT&T. So what that means is if the company and the way they operate, they generate revenue, and their plans for future growth has changed in a major or dramatic way, then I may decide to sell the company if it doesn't match my future outlook anymore. And with AT&T, the one potential growth factor that was really driving me to the company and making me risk that little bit of short-term volatility for long-term potential gain was HBO Max, their streaming service. But after this $43 billion deal that will now be separated into a separate entity and not be owned directly by AT&T, so the long-term value that I believed HBO Max was going to deliver to AT&T shareholders has now been sold off and will be shifted to the new merger. So right away, once this sell-off took place, I had to quickly reevaluate my position on the company, and now that I believe their long-term growth factor has been sold off, I really don't have that much reason to own the company at their current point in time during what I believe to be a very volatile upcoming few weeks. And the third reason to why I'm really unhappy with AT&T right now is their leadership. Just back in March 2021, the company's CEO said that their dividend will not be cut. They have enough cash flow to pay down debt, pay out that dividend, and continue to grow the business. And he actually talked about the future success of HBO Max. So after this interview, AT&T investors had a ton of confidence in the business, and the CEO himself is quoted as saying, "I feel very comfortable that we can sustain that right now and not have to walk away from the opportunity to keep this a strong and sustainable business." So he said just 2 months ago that he believes AT&T can maintain their 7% yield, continue to pay out that dividend quarterly, and grow their business and still become a sustainable long-term brand. And of course, I don't know the company. I'm not one of their execs. I don't sit on the board, but there's no way this company and the CEO did not have an idea of this potential merger with Discovery at this current point in time. And I'm not a fan of big companies who mislead their investors. This interview should have not happened. He should have not mentioned, in my personal opinion, that no dividend cut will be coming, and then 2 months later, create a major deal to sell out the growth of HBO Max to an existing company, and also have plans to cut their dividend after the deal takes place. And now if we talk about the numbers, AT&T will no longer become a dividend aristocrat. They've held it for a few years and will now lower their payout by as much as $7 billion per year. So the company plans to cut their dividend between 40 and 50% from their current level. And currently their payout ratio from their Q1 2021 report sits at around 63%. And after the sellout and after the company's restructuring, they're going to have to resize their payout ratio and get it between 40 and 43% of the company's expected $20 billion of free cash flow over the next year. So this cut will have to mean their dividend payout will come down. Of course, that will make it more sustainable, but after this deal takes place, their cash flows are also going to be reduced, which is why the overall dividend payment is coming down as well. And we can see that currently the company pays out $15 billion in dividends every single year, and that's going to be cut down to right around $8 billion. So it's a major cutback in the dividend, and from the current annual payout that comes in at $2.08, some people are forecasting that after the cut comes in, they're going to be paying out $1.20 per share. And if we take a look at my Simply Wall Street portfolio, now 15% of my dividend income is considered unsafe. And that entirety of the 15% is of course made up of AT&T. And the company was just downgraded the day of this deal from a borderline safe 60 all the way down to a 40, which is considered unsafe. And another rule in my portfolio is I will never hold a company for dividend income that pays out an unsafe payment. It's different if the company is valued for my long-term share price appreciation and they also just pay out a slight dividend that may not be considered the safest, but for a company where pretty much the only goal of owning them is to produce that passive income right around 7% per year, once that shifts to unsafe, the entire value I'm getting from the position is kind of in worry, and that factored into my decision to sell out of the company. So overall, that was my thoughts on the AT&T merger. The company has announced a sellout worth $43 billion of their WarnerMedia position, and that's going to really impact a ton of investors' thoughts on AT&T. Of course, you're still going to get access, if you own the company, to one of the largest telecom names in the world with massive revenue and cash flow every single year. But what a lot of people were really hoping for the long-term growth factor of the business was their entry into HBO Max as a streaming leader. But of course, this new $43 billion deal, which is not small by any means, is going to sell out of that position. Of course, the shareholders are going to get ownership of the new entity, but AT&T itself will not own a majority of this company, and they pretty much just selling out of the acquisition they made for $85 billion just 3 years ago. So overall, that was my thoughts. As always, I'm very transparent with my portfolio. I will be selling out of the entire AT&T position, and when you tune into tomorrow's video, you will see one less holding, and ticker T will no longer be part of the financial freedom portfolio. I'm going to take the around $5,000 worth of cash from this and transition it and put it into other holdings. I may add to some existing positions, I may start new positions, and I'll share with you exactly what I'm buying with these funds after I make my purchases. So thank you for watching to the end. Comment down below what you think about AT&T. Are you going to hold the company through thick and thin? Are you just going to let them cut the dividend and still collect? It's still going to be a nice dividend, just reduced to maybe 3 to 4%. Are you going to hold the shares of the new media company once it goes public? And just let me know your thoughts. I like to have discussions, I like communicating, and I like hearing different people's opinion on the market, especially when it comes to dividend companies. So thank you for watching to the end, and I will see you in tomorrow's video.